Welcome everyone. Return on capital employed. Return on capital employed simply we call ROCE. ROCE. Return on capital employed. ROCE is a profit of a business as a percentage of the total amount of money used to generate it. That's the main definition. Why we calculate the ROCE? We can find out the how much return a business they get, how much profit they earn as a percentage of total revenue, as a percentage of the total capital employed. So you can see the formula here. The one of the most important profitability ratio is the return on capital employed. Return on capital employed, and then it compares the profit made for the business with the amount of money invested, right? It's capital. The advantage of this ratio is that it links profit to size of the business organization. That's why normally the main advantage of this ratio is that it links profit to the size of the business. So ROCE, return on capital employed, can be calculated using following formula. You can see ROCE equal operating profit divided by capital employed into 100, right? So this is the ROCE is a really important factor. Then we can find out what is the gain that you realize from the business organization. What is the gain? What is the return that you get as a shareholder? This is really important. When you invest in the business organization, what is the return on the capital employed? So then you should know what is the capital employed mean and what is operating profit mean. You already know operating profit is the gross profit minus operating expenses, right? So operating profit of the, for example, organization is a Co-Homes case study is a 4.6 million, and capital employed is 20 million. 20 million. So if not stated clearly, directly, the capital employed of the business is the value of the capital and reserves plus non-current liability. So capital employed is share capital, issued share capital plus reserves like retained profits and other general reserves plus non-current liability. So it means equity plus non-current liability, debt plus equity. So capital employed means not only the equity capital, debt capital also we are taking. That's why plus any non-current liabilities. So don't take the current liabilities, but take the non-current liabilities such as long-term bank loans, mortgage loans, debentures. So according to that, you can see 2016 ROCE is 4.6 million over 20 million, that is 23%. And 2015 ROCE is 3.2 million over 18 million into 100, that's 17.8%. Right. So ROCE will vary in industry to industry change. Over the 2 years, Eco Homes has seen ROCE is increasing from 17.8% to normally, like if you get like this much of return means it's beneficial, because see normally if you put your money in a bank, normally every bank will give you about 5%, less than 5%, like sometimes the return for fixed deposits. But by doing a business, by investing in an organization, you can see the return you can gain more than that. 23%, 17% means it's a good return for the investment. So these are good return for the capital compared to the interest rates of the bank in this time. That's why always you have to compare with the interest rate in the bank, because always that's why a lot of people they are doing business. That's why there are a lot of people investing in share market, because the return is higher than the bank interest rate. You can gain much more interest, much more return than the banks. So rates were often normally less than 1% on the bank deposit in 2016, like that is in UK and all, but in Asia, it's like especially Sri Lanka and all the other countries, we got a interest rate like from the bank. Still, we are getting about 5%, 6%, 7% like that. So interest rate. But when you compare to the US and UK, European countries, it's very low. Bank deposit rates are really low. That's why a lot of people are tend to do business, investment in share markets, investment in real estate and everything, because they can earn much more return. However, it must be remembered that the investing money in a business is more risky compared with the leaving in a bank. That's the thing. So investing in a business is a very risky option. High risk, high return. Low risk, low return. Like that, you can see there are past paper questions also there from this ROCE and everything. I'll take one example from the this revision pack. You can see this is the return on capital employed example. This question came in 2016 2017 IGCSE past paper question to calculate the return on capital employed. Right. If you go to the past paper questions, here you can see the 2017 past paper question. This is the my see the now revision pack, financial management revision pack. So there I have given the all past paper questions plus all worksheets regarding the financial management. So if you go to the past paper section here in the down, you can see 2013 paper, 2011 paper, 2019 paper, right? 2017 paper, I'll show you. 2014. Here we go. 2017 paper, right? HTL. HTL is a case study. You can see the HTL, the Hugon Transport Limited is a case study. This business they have asking to calculate the ROCE, right? This organization they're asking, table below shows the extract of HTL financial position. HTL financial position. You can see the turnover they have given from 2015 to 2016. Turnover improved. Cost of sale 10,000 to 12,000 level improved. Gross profit improved 8,000 to 11,000. Net profit, right, 3,200. Profit for the year improved 3,200 to 4,600. Current assets improved 11,000, 13,000. Current liabilities improved 7,800, 8,700. Capital employed improved 18,000 to 20,000. So asking, calculate the return on capital employed, ROCE for 2016. If you want to calculate the ROCE here, what you have to take the net profit, right, divide by capital employed into 100. So that is, right, if you use a calculator, so net profit here 4,600, divide by capital employed value 20,000, multiply by 100. So answer will be there. Yes, I see. So audience giving the answers here. Yes, 23%. Yes.
Sir.
Yeah. So this you have to. I think in future I'm going to discuss this one like this revision pack after finishing this all financial management thing. So you can join it in the future session. We are going to do this revision pack and before the examination. We are going to cover all the financial management topics again. We are going to revise. Right. So so ROCE here you can see 4,600 divided by 20,000 into 100, which is 23%. 23%, right? And asking the second question is what would ROCE ratio indicate to shareholders such as Sunita and Ben? The shareholders are mainly Sunita and Ben. This is the this question I would like, because this is all syllabus. 2017 is all syllabus. Now this question we don't have 5-mark questions. We have 6-mark like analyze question. Analyze, or sometimes I can convert this question as, for example, outline question. Outline what is ROCE indicate to their shareholders. So that means they're asking to define what is the meaning of this 23%, which means Sunita and Ben, by investing their money, 20,000 pounds in the business, they are getting 23% return from the HTL business. This is actually transports, traveling. They have the motor coach, they have buses, and they are doing tourism, the passenger transport in UK. So so that means they are by investing 20,000 pounds per year, their return is 23%. That is the indication to shareholders, and we can figure it out by if you want to, you can do a comparison also by 2015 to 2016. 2015 ROCE you can see 2,000 net profit 3,200 divided by 18,000 into 100. So that is 17.7%. 17.7%, and this year it's 23%. You can see that means the ROCE, return on capital employed, has improved between 2015 to 16. Like that, there are a lot of ROCE calculation and current ratio calculation, everything. They're asking different questions are there, past paper questions. So this question I selected because it's ROCE related question. ROCE related question. Okay, let's go back to the comparison section. Using ratios to make comparisons. Ratios can be used to assess the performance and liquidity of a business. Performance mean gross profit margin, net operating profit margin. Liquidity ratios we discussed in my previous session. Current ratio and the asset test ratio. So we can analyze, we can compare the performance and liquidity of a business organization at a particular point in time. They can also be used to monitor the progress of a business over time. The statement of comprehensive income SOCI and the statement of financial position both show the figures of the current financial year and the previous financial year, right? So always that's a normally every organization, they have to show the current financial year and the previous financial year figures in the two columns. We call year on year analysis, because they can then only we can get the meaningful picture, because 1 year figure is not enough. We have to at least 2 year figures. We can find out the previous year figures and this year figures. We can find out there's a good or bad improvement or decline of the progress and the performance and the liquidity. This means that the ratio can be calculated company and compared immediately, right? So that's the thing. Normally, I'll show you this, and also you can compare these results with the close rivals in the same industry. That is also really important. This will help to judge the performance of a business compared to the closest rivals. If it is a let's say hotel with another hotel, if it is a transport company with another transport company, okay, it's like that. You must take the same industry or bank with another bank, similar size. So always when you're comparing, take the similar size of the business organization and similar nature of the business organization. That then only you can get the meaningful idea. Then only we can do any comparator analysis. Then only we can get the meaning. For example, we cannot compare a bank with the hospital, because these are two different natures, two different sizes of the business, and the business volume, business nature is different. You have to compare bank with a bank, hospital with a hospital, right? School with another school, like that. Then only, because nature of the activities should be equal. Keep in mind that as well, right? Yes, so when you're making comparison, you can make very good idea. Example, we can find out whether better to invest in this business or whether to invest or divest. This decision can be taken. Okay, let's go to these MCQ questions. I'm asking audience to answer this question through chat line. Gross profit is equal to which of the following? Gross profit is equal to which of the following? Operating profit plus revenue. B, revenue minus cost of sale. C, revenue minus operating profit. D, revenue plus cost of sale. Yeah, I got 3 correct answers from students. Correct. Tiara, Tessa, everyone gave correct answer. B is the correct answer. Revenue minus cost of sale. Very good. Second question, a business is likely to have a sufficient working capital if the current ratio lies between which of the following? So I told you yesterday, current ratio, there is a like safe zone is there, current ratio. They're asking this question, like normally current ratio as well as asset test ratio, there are benchmark standards are there. They're asking what is the benchmark for current ratio? 0 to 1, 1 and 2, 1.5 and 2, 2 and 3. So here also I got 4 correct answers. Correct answer is C. C is the correct answer. It should be 1.5 and 2. 1.5 is the satisfactory level, 2 is the ideal level. Therefore, current ratio always should be lie between 1.5 to 2. If we go below the 1.5, which means that is financially, they are liquidity wise, that is bad, they are not safe. And if you go above 2 means that also sometimes it is not ideal, because if you go above 2 means that is we call unnecessarily your cash will be stock, what you call cash tied up in the stocks, or cash will tied up in the current assets. That means you had used that for proper profitable functions. That's why that's also in vain, because if you keep too much of cash in the business organization, that's also not good. So always the ideal rate is to keep the cash between 1.5 and 2. 1.5 means 1.5 is to 1 and 2 is to 1, which is 1.5 current assets to 1 current liability, or ideal level 2 current assets to 1 current liability. Okay. Third question. If revenue is 500,000 and the operating profit is 100,000, right? Revenue 500,000, operating profit 100,000. What is the operating profit margin? So operating profit margin equal, operating profit divided by revenue into 100. So it's 100,000 over 500,000 into 100. So it's 1 over 5 into 100. You can see it's 20. So I got 4 correct answers as A. Very good. All of you get the correct answer. Kia, Liara, Mohammed, everyone. Very good. Last question. The ROCE is given by which formula? Just now we talk about the ROCE, return on capital employed. So A, gross profit over revenue into 100. That is gross profit margin. No? Operating profit over capital employed into 100. C, operating profit over revenue into 100. That is actually operating profit margin. D, current assets over current liabilities. That's a current ratio. The correct answers, I got, yes, few correct answers. B is the correct answer. Operating profit over capital employed into 100. All right. Let's go to this chapter review question. Al-Dhabit Shipping line. Right now, the worldwide, because of the pandemic, the shipping lines, everything actually that also hit. For example, airlines, shipping lines, everything, because international trade, everyone actually halted. They have some kind of a bad period. For example, total airline industry was gone down by 70% last in 2020. Everything, railway transport gone down, road transport, shipping line also like that. They hit from the great pandemic. So Al-Dhabit family in Oman owns Al-Dhabit Shipping Company, and its main business is transportation of oil. In 2014, the drop of demand hit the company and the price of oil fell very sharply. The owners injected another $2 million to the help business to survive. And some financial information for the company shown in the table. 2013, 14, 15, you can see the financial figure, revenue, operating profit. You can see revenue in 2014 gone down. And again, there's a recovery to 11.9. And operating profit also same. Operating profit 1.1 million and 0.3 million, and one is a US 2014 was not a good year. So we can see the figures gone down, but there's a recovery again in 15. Current assets also same, up, down, and up. Current liabilities also same. Current liabilities improve because they have to take so much of loans. And then capital employed value is 10, 12, and 12. Right. So what are the questions they're asking from this chapter review? By looking at these figures, they're asking 4 different questions. Return on capital employed is a performance ratio. What is meant by this? What is ROCE? Second question, work out the operating profit margin, current ratio, ROCE for Al-Dhabit Shipping for each 3 years. Operating profit margin, operating profit over revenue into 100. Current ratio equal current assets over current liability. ROCE equal operating profit over capital employed into 100. And third question asking, discuss the benefit of using ratios to compare the performance of a business over a period of time, right? 2 benefits of, this analyze question, analyze the benefit, 6-mark question of benefits of using ratio. We'll see what are the benefits of using ratio. And last question, assess the performance of the Al-Dhabit Shipping between 2013 to 15. Make a clear judgment in your evaluation. So this is a kind of a 12-mark question. Evaluate the performance of the Al-Dhabit Shipping Company. Okay, let's go to the mark scheme. For example, before you write this question, you have to do all the workings and get ready. Then only you can make a meaningful answer. So what is meant by this meaning of the capital employed, ROCE? Performance ratios show how profitable a business is. The ROCE shows how much profit the money invested in the business generates, right? So that's why how much the profit the business generate on capital employed. And these are the values, right? You can actually check from yourself, like, operating profit. It's better to actually provide like in a table, operating profit margin. You can see how they can clearly indicate that 2014, their values goes down. 9% goes to 3%. And again, they have recovery 59.8. Current ratio 1.49, like slightly is actually 1.5 is the satisfactory level. Is they are on like a slightly, like almost satisfactory. 2013, and it's gone down to 1.02, that is bad. And then again they recover in 2016, 15, that's now in the safe zone. ROCE, I can see 11.3 return company, they gone down to 2.8 return, and then again they increase to 9.7%. Now we can see the benefits of using this ratio. Benefits of using ratios to calculate the ROCE. Ratios can be used to assess the performance of a business over time. Ratios can be used to assess the performance of the business over time. This means that the performance can be tracked. Calculating ratio in one particular year may not be very helpful because there is no basis for comparison. There is no basis for comparison if you calculate for individual year. Also, the particular year used might be an unusual year, so the result would be misleading. That's why the comparison year should be not unusual year like 2019, 2020. Those are unusual years in normal like recent past, because pandemic is an unusual thing, right? So therefore, when you are comparing, you should use like a general year, like a normal year, not a unusual year. Therefore, otherwise, if you are comparing like that, it should be misleading. Example, let's say if you compare 2014 with 15, that's a huge gap, huge improvement. But actually, that is not an improvement because that's a recovery, right? For example, let's say if you judge the 2020 next year results with the last year results, because I'm thinking that next year would be 2022 would be better than 2021 and 22 like that, because I think slowly this pandemic will be gone, and because a lot of people they are now it's a new normal life, they are struggling to survive with the new normal, with the pandemic. So then I think that everything, economic activities will be normal, education system, school will be open, so our activities will be, we can do as usual in the normal life. So as a result, then what happened, if you have that kind of if you're comparing with the unusual year, the results would be misleading. However, they're looking at the ratios for a period of time, like 3 years in this case, it is possible to make a comparisons and identify the patterns or trends of the performance, and this must be more helpful. Okay. The last question is really important question, like it's a clear judgment. They are talking about the evaluation, the performance, which is shipping line, right? Okay. So I'd invite, okay, Divyan, can you read the answer?
Yes. Assess the performance of Al-Dhabit Shipping between 2013 to 15. Make a clear judgment in your evaluation. Over the 3 years, the operating profit margin has risen from 9.04% to 9.83%. This is a small improvement, but during 2014, the operating profit margin fell to 3.54% when both the price of oil and demand fell. This does not suggest that there is a problem with the business, just that trading conditions are difficult. The current ratio has also improved over the time period from 1.49 to 1.64. If the current ratio lies between 1.5 and 2, the business is said to have adequate working capital. Since 1.64 lies in the range, Al-Dhabit Shipping appears to have enough working capital to fund its day-to-day activities. However, the current ratio did fall to nearly 1 in 2014, which provides further evidence that trading was difficult. Finally, the ROCE has fallen over the 3 years from 11.3% to 9.75%. The company is still recovering from the difficult trading conditions, and in 2014, the amount of capital employed was increased when the owners injected another $2 million of capital. Clearly, the operating profit has not risen enough yet to recover the lost return.
Yeah, thank you. Now it's a very good in like a technical writing. I think you have to very. I'm today. I'll in my lesson, the later of this lesson, I'm going to teach you how to write this kind of a question. Technical analysis is really important. So today lesson, I'm going to teach you how to write this kind of answers. I'm going to do one more question like this, and I'm going to explain you when you are writing, you have to improve your standard like this way. Because if you just say, okay, I'm performance improve, gross profit margin improve, ROCE has improved, and this year gone down, it is not make a good sense. You have to write like a professional. When you're writing like a professional, you have to make sure that your numbers are there always, and the not all numbers you have to supported points are there. For example, proper application you must able to use. For example, this case is it's oil transportation, it's a shipping line which mainly transport oil. So what happened to their business? During that year, the price of oil and the demand for oil gone down. So this is the bad situation, bad scenario they have happened. The price for oil and the demand for oil actually badly affected their financial problem. So as a result of that, you can see the organization performance has gone down heavily, right? So organization performance gone down heavily between, you can see, and the current ratio also, you can see the current ratio also gone down, especially 2013. This situation is like that. But normally you can see the organization, the current ratio, they given the better ratio, it should be between 1.5 and 2. 1.5 and 2. So basically, if you have the 1.5 and 2, that is okay. But the problem here is sometimes they have achieved this ratio, especially 2014, they have recovered, but in 2030, they haven't. You have to mention that thing. You have to show that you know all these things, right? Because if you don't mention these points, you must be sometimes you're not going for like a higher level achievement. So always make sure you are writing the correct points and the correct application, and you can use the proper application means you can use it years, you can use a figure like a percentage figures and everything, right? And you can the conclusion and everything. You can see there's another small part is there remaining. Yeah, so that's the thing. So mainly this question is the main technical part. When you're writing a technical question like that, make sure you have to use enough evidence, right? Normally 12-mark question, what we expect: definition, 2 positives and 2 negatives, and a conclusion, right? So I'll taking you to another question. This is a worksheet actually for the ratio analysis. You can find out it's like an overall picture about the ratio analysis, how to do a comparison and how to do the calculation. And so far what we learned from this lesson is they are reflected from here, you can see. And from this part I'm going to teach you how to write a proper comparison part, how to write a technical part properly. You can see using practicing question here, read the information below and calculate the ratios for 2 years. First of all, we'll do the calculation, then I'm going to teach you how to do the comparison. For example, here you can see this red color things. You have to find out those figures, and then we are going to calculate the gross profit margin. We are going to calculate the operating profit margin, markup ratio, ROCE, current ratio, and acid test ratio. All these 6 ratios you have to do now. And also I'm going to interpreting part is a really important section. I'm going to interpreting the what happened to the gross profit margin, what happened to the operating profit margin, what happened to ROCE, what happened to markup, right? I'm going to teach you that section also, and what happened to current ratio, acid test ratio, right? And also there's a final part I'm going to do comparing ratio. There's another question to comparing ratio. This is the way of professional writing. I'm going to teach you that also today in this session regarding how to write a proper thing, because these are all the ratios they have given, right? First of all, let's go to the previous one, the calculation section. The formula sheet, you know already, these are the formulas. Gross profit margin equal gross profit over revenue into 100. Operating profit margin equal operating profit over revenue into 100. ROCE equal operating profit over capital employed into 100. Markup equal profit for the item divided by cost per item into 100. Current ratio equal current assets over current liabilities. Acid test ratio equal current assets minus inventory over current liabilities, right? These 6 ratios you should know, but normally we are giving a formula sheet in the examination. In every paper you have a formula sheet, right? Okay, let's calculate these things now. You know the value gross profit equal sales minus cost of sales. If you minus these figures, you can find out these values, sales minus cost of sales, and then gross profit minus expenses, then you can get the operating profit, right? And this is 2016 and 17. In SOFP, they have non-current assets, fixtures and fittings, current assets, trade receivables. Then you can find out the total assets here, total current asset figures. You can find out these both years by adding them up. And current liabilities, you have trade payables, and the capital employed figure is there, 1 lakh in 2016 and 90,000 in 2017. Profit per item and cost per items separately given in order to calculate the markup. So now I'll show you how to calculate these figures, right? So this question will be really helpful for you, like in order to do the remember all the calculation. Okay, you can see in this marking scheme, right? So the gross profit margin is gross profit over revenue into 100. So gross profit is 105,510 over revenue 185,500 into 100. That is 56.88. Right? Always make sure to give the answer for 2 decimal points, because in always organizations, 2 decimal points they're expecting in the past papers also. Sometimes unless they're asking for the 3 significant figures or 1 decimal point, always give your answer for the 2 decimal points with the percentage sign. So we can see the 2016 GP margin, what happened, 56%, and 2017 it is gone down to 49.42. It's gone down. Operating profit margin, what happened? Operating profit margin also gone down 32% to 21%, right? Operating profit over revenue into 100. Markup, profit per item over cost per item into 100. 2016 markup is 181.82. 2017 is 193, is improved markup. Profit per item 95, cost per item 49 into 100. ROCE, operating profit over capital employed into 100. So 2016 ROCE is 60.06%. 2017 is gone down 52.53%. Current ratio, current assets over current liabilities. 2015 it's a 1.3:1. 2017 is 3.3:1. So 2016 is bad, actually it's less than 1.5 also, but 2017 tremendously they have improved because the 75,000, you can see they are mainly go to the question, their current asset level has increased because inventory double, 25,000 to 50,000, they double. So as a result, total current assets improve to 75,000 and current liabilities 25,000. So therefore they have a 3 times, 3:1, right? 3 current asset to 1 current liability. And finally, you can see the last one, acid test ratio, current assets minus inventory over current liability, then that is 0.5, less than 0.75. So, acid test ratio safe zone is 0.75 and 1. In between, satisfactory level 0.75, ideal is 1. Here, this is less than the satisfactory level, but this here is ideal. So 75 minus 50 over 25 means is 1:1. That means 1 quick asset to 1 current liability. Okay. I think I'm pretty sure that the calculation part will be easy for you because these sections are again you are covering in the accounting as well. But interpretation section is very important. In business only we are teaching the interpretation section because most of the times your questions what you need to know as a future business leaders, right? The students of the business section. So you should know how to interpret the financial statement. So by looking at the thing, you can see now look at the table and the interpretation. Gross profit margin. Now 2016 to 17, there has gone down. You can see GPM or gross profit margin is decreasing slightly. The business should watch this closely to ensure it doesn't fall again. Right? This is how you have to write. Right? Maybe they could try to bulk buy and get discounts, reducing the cost of goods figure and therefore increasing the gross profit. Right? That's the thing. Maybe you have to take the think about it. You can see this is they are giving some kind of a interpretation, means you are giving you're pointing out the problem and you are giving the solution also. A good financial analyst must be able to identify the problem and must be able to give the solutions also, right? Because anyone can say, it's gone down 56 to 49, it's gone down and then it's bad, but that is not enough. You have to give the solution also. Like I see, so it's gone decreased slightly and they are giving the solutions also for this question, right? Business should watch this closely to ensure that this doesn't happen fall again, right? So maybe what is the solution they can do? They should try to take a bulk purchase and get discount, and discount reducing the cost of sale, right? And get discount reducing the cost of sale. So you have to think about like that way. Then only you can reduce the gross profit margin. And then actually, if you get a discount, then you can reduce the cost of sale, and then you can increase the gross profit. Look at the second one, operating profit margin. The operating profit margin, that also gone down 32% to 21%. Other expenses must be reasonably high because the ratio has dropped. The business could look at this to see if any expenses can be reduced. The organization then, what is a solution here? Do some cost cutting. Think about the ways that you can reduce the cost. It is all right. The concern that the operating profit margin has fallen approximately 10% since 2016. Right? So normally that the operating profit margin here gone down more than 10%, 32% to 21%. Right? Approximately 10% since 2016 is gone down. Therefore, organization always thinking about, in order to face this kind of a challenge, business should look into see if there's any expenses they can reduce. Cost cutting, cost controlling is a main option, because operating profit margin always finding out it's a giving indication how much their administration costs, how the cost controlling and everything comes. Look at the ROCE. ROCE here, that also fall 60% to 52.5%. This has fallen considerably since 2016, which is a concern for potential investors and might put them off investing in the business. Yeah, if the return goes down like that, investors will discourage to invest here and they will go somewhere else. However, the ROCE is high compared to savings asset. You have to say that part as well, even though the business ROCE going down, 52% is actually compared to other investment opportunities, like example, bank interest and the fixed deposit interest rates and everything. This is much higher return. Look at the markup. 181, 193. The markup has increased since 2016. It would be interesting to investigate why this has happened, because we don't have enough evidence for that, right? So you have to investigate why this has happened. Look at the current ratio. The current ratio is 1.3 and it's increased to 3.1. In 2016, for every 1.3 the business owns, it owed £1, and it increased significantly in 2017 to 3:1. That is, every £3 the business owns, they owe £1, 3:1. Three current assets to one current liability. This shows there is an opportunity for more borrowing in the business to fund the possible expansion. Yeah, you can go for more borrowing because they have enough assets, and the business need to make that the £3 work for them is being too liquid. It's a waste of resources, because as I told you, 3 is kind of imagine keeping this much of current assets is a waste of resources. Telling that also. Look at the asset test ratio finally. 2016, for every 50 pence the business owned, it owed £1. Now, once we take away the stocks from the assets, this is concerning to suggest that a lot of money is invested in stocks. The situation improves considerably in 2017, where for every £1 the business owned, it owes 1:1. One current assets, one quick asset to one current liability. The business can therefore cover its liabilities with its assets once the least liquid of all assets has been removed, like stocks and everything you can remove. However, the business could want this figure to still be a little higher, right? So that's why I think organization thinking this is a very strong position, but because they are removing all the stocks from there, and then this is the all liquid asset business has. So always, however, the still business would want this figure to still be little higher. Right. Now I'm going to show you another one, like the second part, the last question of this worksheet. The second question, the calculation and interpretation part is over. I think you can get some idea about that thing, right? You again and again this recording, then you can find out what are the main points here. Then you can actually find out how can you write a better answers like that. Okay, now we are going to the section 3, comparing ratio. Comparing ratios. This case, we have to, they are given straight away, all the ratios as given. You have to compare the ratios and you have to come up with the comments. Look at the commenting part is the most important.